Namaste traders. Today I'm on the 19th of March 2020 and I thought of quickly making this video. I thought of 6 pointers that we should look into our portfolio, especially during a bear market. But before I share these 6 points, out of which I particularly like point number 3. Point number 6 will be a surprise for you. You may like it, you may not like it. Do watch this video till the end. And before I share these 6 pointers with you, let me ask you a question. That at the current state of the market, which is literally distressed, are you looking at your portfolio regularly? If I take you back 6, 9 months, 1 year back, when the markets was doing pretty well, I'm sure quite often, depending on your regularity, you would have checked how much gain your portfolio has gone through over a period of time. And you would have enjoyed looking some positive returns on a day on day, week on week, month on month, whatever is your periodicity. So my question is, at this current state, are you still checking your portfolio as frequently as you were doing before? Please answer me. Leave some comments at the end of this video and tell me whether you are doing it or not. I strongly sense that the answer is a big no. Well, I'm not predicting or guessing this. Essentially, I've been talking to a lot of people, especially friends, and they know me that I'm into the stock markets or for so many years and I do trade and invest and mentorship traders, etc. And they tend to ask me, they've been asking me quite often nowadays because of this fall, that what's happening? How bad can this get? Me being some kind of a domain expert, I don't know if I can call myself that, I share my understandings. And I've noticed one thing, most of them told me during these interactions that, you know what, the bleeding is so bad in my portfolio that of late I've completely stopped looking at it because I don't want to see my portfolio bleed that bad. Are you doing the same thing? Do let me know. Do leave a comment. So, before I go to these 6 points, it's very interesting, it's very important to realize how the human behavior reacts to different situation. Let me draw some kind of a analogy. Let's say your health. Okay, of course, a lot of rounds of news, talks, and everything is pertaining to the COVID-19, and it's of course related to our health. Now, if something goes wrong with your health, let's say you've got, I don't want to, say that you've got a fever. I don't want to spike you up, but let's say you've got a little cramp on your some kind of a shoulder muscle. Let's say you've got some kind of a cough and cold or whatever. What I'm trying to say, if something goes wrong with your health, do you pay more attention going forward, or will you pay less attention going forward? When everything was going well, when you were healthy, did you pay attention to your health every day, once or twice every day, or once or twice every week? No. We generally tend to pay attention to our health when things go wrong, when we are unwell. That's when we know that something is not going right, symptoms. Given it's a time of couple of days, it doesn't cure itself on its own, then visit a specialist, which is a doctor. Prescriptions and medicines are given, and then you tend to check yourself hourly or daily or quite frequently, depending on the severity of your case. So essentially, when it comes to your health, you pay a lot of attention when you're unwell, and you don't pay, I would say, very little attention, if at all, when you're not well. Why then you do the same with your wealth? When the markets are nice and it's going up and your portfolio is also rising with the overall behavior of the market, you check on it very, very frequently because you enjoy the fact that your investments are giving more money. You feel good. That's why you come back to that page. Either you open a website or your bank's page or your app, whatever. But now that the market has completely crashed, you don't want to see it. You don't enjoy the feeling of seeing your portfolio down so many percentage or so many lakhs of rupees. So that's completely different approach from the same person I realize when it comes to health and wealth. I, on the other hand, believe that the approach should be the same. When it's not going right, when the going is not going right, in this case and in this case, when you're unwell, the degree of attention should be much more than when it was going well. Ideally, it should be a little consistent. So, now that you've got my point from where I thought of this video, so I'll share with you 6 points which I feel are important that one should keep in mind. Point number 1, diversification. You need to check now that your portfolio of stocks, your portfolio can be of, let's say, stocks in your demat account. Your portfolio can have mix of mutual funds, right? You need to check that your investments are well diversified or not. Over here, I am making an assumption that it's a outright equity investment. So in the various types of stocks that you have bought, is it biased towards any particular sector like banks or IT or pharma? Do you have lots and lots of these? Try not to. A good benchmark would be if you take a look at the Nifty 50, you would find around, I guess it's 13 sectors, out of which the top 15 stocks will make up close to 67% of the total index. So you need to know that the portfolio that you have created or on the verge of creating over a period of time, it should have a little bit of many sectors so that it is well diversified. See, if you're new to the market, the kind of fall that you're experiencing now is essentially breaking all the stocks and all the sectors across the board. But that's generally not the case most of the time. When healthy bull market corrections come in the tune of 8 to 10, 12, 15%, few sectors perform better than the others. A special one would be something like IT, which benefits from the movement of rupee and dollar. So you need to know that whether my portfolio is well diversified or not. Banks are getting really beaten in this fall. You need to check, am I bank heavy? Have I got any kind of mutual funds which is into some kind of a thematic fund which is purely into banks? Then you need to be a little careful. Just check how well are you diversified. I'll strongly suggest look at the constituents of Nifty 50, look at the various sectors which make up the Nifty 50 and use this as some kind of a benchmark. Use this as some kind of a benchmark based on which you will create your own portfolio. That these are the kind of sectors that I would like to have. Number two in my list is correlation. Check for correlation amongst your entire portfolio. When it comes to correlation, you need to check that if you are well invested in various asset classes, is my asset class number 1, how much is the correlation with the asset class number 2? So you can look at, let's say, something, for example, you would like to check if I have a portfolio of equity, how is it correlated with that of gold, or let's say real estate, or let's say bonds, corporate bonds or government bonds, etc., etc. This will trickle down to my third point, which is very important. But it's also very important to know that, are you investing only in one core asset class? Are you, let's say, most of the Indians, I believe, would be equity heavy? Now, I can make a judgment like this because a lot of marketing has happened over the last more than couple of years on SIPs and equities and SIPs. I am a big believer of SIP. I myself am a big believer of equity markets. But we need to understand that equities are far more volatile than debt. I'll talk about this a little later. But you need to understand what are the various asset classes, and do I have my money and I have my fingers across all these asset classes? So you can look at commodities, you can look at currency, you can look at gold has come under that. You look at real estate, arts, wine, fine arts, etc., etc. There's so many different kinds, and you need to. I would strongly suggest that have a little bit of all or little bit of more, and have those which are less correlated with your existing holdings. Okay, if you already have 7 SIPs going on 7 different schemes, all are putting in money into the stock market, it doesn't make sense to put money on the 8th scheme, which is again going to put money into equity. Maybe something else which will not get impacted when the equity comes down or goes up. So correlation. Number 3, to a lot of extent I have discussed about this in point 2, but in a little more detailed manner would be your debt equity ratio. See, I told you some time back that it is very, very important to understand equity is extremely powerful. It is equity which will give you that thrust, that push, so that your money, your investment goes multifold over the period of time. That can only be possible with equity. 10 to 15% CAGR over a period of time worldwide is all sounds good on the hindsight. It all looks good on the spreadsheet. But when you live through it, when you actually create an equity portfolio and live through it and wait for that kind of a result to come, you have to stomach volatility. You will see your portfolio coming down significantly, and only then will it go up significantly, or else it's not possible. That is the nature of equity. However, the debt, on the other hand, is far more stabler, but it will not give you that kind of push or thrust which equity can give. So you need to marry them both in a nice ratio, in a nice order, so that overall, when you look at, let's say, 30 years of investments, you're not like going up, coming down, going up, coming down, not like this, but rather far more smoother. And this is only possible when you have a good debt to equity ratio. I will be coming out with various videos over the next couple of months' time talking about how to create a good investment portfolio. But as of now, for this point, I would say look at your portfolio. Do you have any debt components to it? If not, please start reading about it. Please start adding more debt. Though this is not the right time, because this is a very good time to add equity because it's relatively cheaper. But you should now focus on debt equity ratio. Number 4. Number 4 is directly related to your existing holdings. Look at your stocks or mutual fund holdings and look at the ones which are underperforming. All right. And compare that with others which are outperforming. Now, let's say, for example, I'll make a generic assumption that most of you might have multiple mutual fund schemes. Okay. Now, all the schemes would have come down. All of them, let's say if you have 5 schemes, would have come down. Now, you need to check which are the ones, and you make a benchmark. You check that these schemes are benchmarked themselves with what? You'll find most of the time it is benchmarked with the Nifty 200 index. You need to quickly check over the last 3 weeks or 4 weeks how much percentage has Nifty 200 fallen, and what is my scheme number 1, scheme number 2, scheme number 3, 4 and 5, how it has fallen. Less, more, same, etc. Figure out which are the ones we are doing good. The ones you figure out, let's say scheme number 4 and scheme number 3 is doing very good. These are my outperformers. I will keep on, investing in them. I might extend my SIPs once it completes. But if you figure out a scheme, a fund house, some kind of mutual fund portfolio which is underperforming big time, it will take a lot of effort from this scheme to bounce back from where it has fallen. And surely you would not like to put in more money to this. Surely if the scheme gets over, you might not discontinue. You might redeem it also once it gives you a bounce back. So you need to know amongst your various stocks or various mutual fund schemes that you're holding, which are the ones which are outperforming and which are the ones which are underperforming. Number 5 is about homework. Number 5 is about homework is, yes, your portfolio, my portfolio, everyone's portfolio, it's down. Accept it. We know that. There's no hiding from it. But then what I request you to do is go through websites of various mutual funds and check. Let's say when you invest in a mutual fund, you generally like to check which fund has given the best return over the last 3 months, 6 months, 1 year, 3 years, etc. Do that kind of a research. Do that kind of a homework. I check my, whenever I need to read anything about the mutual fund industry, etc. I strongly suggest checking the Value Research website. I like it. There are other websites also. Amphi websites is also there. But do a little bit of homework to figure out which sector or which mutual fund schemes have done well. If the debt portfolio has held well, then which are the ones, which fund houses doing well. So need to know that when the shit hits the fan, that is when things go really bad. In this bad kind of a situation, are there any funds which have not broken significantly, which are still okay, in fact which have given us returns? Because this thing will come again after 5, 6, 10 years, I don't know, but this is repetitive. It will come again. So you better learn from this experience and be prepared for the next one. And sixth point, which is a little funny one or a little tricky one, as I said, you might like it or you might hate it, is that the sixth checkpoint is, why don't you check my YouTube channel? I know, as I said, you might like it or may not. Do share your comments below. If you have not subscribed and you've been following me and you like my content, do subscribe, and there's something called a bell button you can hit and you'll get notified. So I've been pretty more active in this fall because I get most of the queries asked by my students and friends during a stock market correction. My friends call me more during a stock market fall rather than a stock market rise, because that's when they think of me the maximum. Same goes with my students also. And that's why, rather than answering 7 of them, I thought, why not make videos and share it with 700 of you? And that's why I've been making these videos. Quite a few videos I've made recently, and I'm quite sure that going forward also I will continue to do that. And if you continue to check my YouTube videos, you will find that most of the questions that you're seeking pertaining to trading, stock market, investments, you'll get some answer, my kind of answer, my way. So the sixth one is, check my YouTube videos. It might help you. And yes, suggestions. You would have noticed that many videos I dedicate to my viewers who come up with a beautiful idea. Why don't you share your view on this topic, on this concept, on this approach? And not only it helps me to think about, okay, this is going to be my next topic on my YouTube video, but it gives that interaction going on between you and me. So the sixth point, check my YouTube videos. I hope you like this point. Do let me know. And there you go, guys. These are the 6 checkpoints which I think you should follow in a bear market. I'll quickly revise it for you. Diversification, make sure your portfolio is well diversified across various sectors. Correlation, you should have multiple asset classes which are as less correlated to each other as possible. Debt equity ratio is something that you should keep in mind all the time. Equity, very good asset class, extremely volatile. Debt, okay, kind of an asset class, steady. You need a mix of both. So look at your current portfolio. What is your debt equity ratio right now? And if you find it out, let me know, comment below, tell me your age and your debt equity ratio. I would love to reply back to you. Let's say, for example, I am 40 and I would say, age 40, my debt to equity ratio is 60 and 40, or 60, 30 and 10 in gold. Let me know what is your debt equity ratio. Underperforming and outperforming stocks or mutual fund schemes. Look at your current portfolio right now and figure out, compared to a benchmark like a Nifty 200, which are the funds or the stocks which are doing better or worse. Keep the ones which are doing good. Bunk the ones which are not performing over a period of time. Homework. This is a very good time to do homework and also to learn newer concepts about the stock market. The markets are down, beaten down, no one is actually that much keen on it. This is a time where do some research and figure out which are the portfolios, which are the mutual fund schemes which are doing good and why they are doing good or not as bad as the rest, why they're doing better. So try to have these kind of schemes or portfolio or funds in your portfolio. And sixth, check my YouTube videos. If you like them, please like them, subscribe my channel, and do share your suggestions with me. It gives me a lot of confidence to make these kind of videos and share it with you, and we can interact. From these interactions, I tend to learn also each and every day. So there you go, guys. Thank you for watching this video till this end. This was a little longer one, close to 22 minutes. I hope you liked it. Let me know. Till then, live well.